if there's a dividend strategy that 100% of profits are siphoned out of the business every year, then a bank may want to understand what that is.
How do finance providers approach pre-purchase structuring? For example, if the business has high cash reserves and retained earnings, declaring dividends prior to purchase. So, and that's more maybe an accounting-y thing, but yeah, let's say a business has $500,000 of goodwill that the buyer wants to buy, but the company it's in has $1 million worth of retained earnings. How would the banks like that approached?
It's an interesting one. I mean, the banks are always going to want to understand any sort of dividend strategy around a business. So if there is a retain dividends coming out of the business and where that might be going will reduce a business's ability to repay the debt. So if there's a dividend strategy that 100% of profits are siphoned out of the business every year, then a bank may want to understand what that is, and they may actually covenant around not taking that much money out of the business. If it's a strategy of a growth strategy whereby a business might declare a dividend to then release the cash to then put towards another business, then that would be acceptable as long as the bank understood how that was transpiring and the benefits of doing that. So it's a hard one to answer specifically. It really comes down to explaining what's happening and having the bank be comfortable with that explanation and being comfortable that there's not going to be any future impact to an ability to service the loan or impacting on the business's balance sheet position that may then impact on asset values and that sort of thing. So it really comes down to an understanding exactly the purpose behind that transaction and how that's going to impact on the future for that business.